Banks are sounding the alarm. Over the last couple of months, the Federal Reserve, banks, and lenders have been preparing for what I believe could be the catalyst for a major market shift, or potentially a full-fledged market crash. Between a rise in consumer debt, a credit crunch, and the hoarding of cash by big banking institutions, the data doesn't look good. And in this video, I'm going to explain why. Americans are having a harder time than ever getting approved for car loans. In fact, according to a recent study released by the Federal Reserve, the rejection rate for auto loans has recently hit 14.2%, which is the highest rate that we've seen since the Federal Reserve started tracking this data back in 2013. And this means that of everyone that applies for an auto loan, 14.2% of those people end up getting rejected. It's important to note that auto loans aren't the only types of loans that are seeing a rise in rejections. Mortgages are as well, but we're not going to talk about that in this video. Now, this report by the Federal Reserve was released a couple of weeks ago, but it's a report that they only release about once every 4 months. Now, we're going to be coming back to this report here in a few minutes, but right now I want to talk about why we've seen such a rise in rejections over the last couple of months. And the first reason is because interest rates are higher and thus it's significantly more expensive to borrow money. For example, if you were to purchase a $50,000 car back in 2021, if you were to put 10% down and had a good interest rate based off of your prime borrower status, you could expect to pay about $3,100 in interest payments throughout the life of that loan. That's with about a 2.5% interest rate, which was a pretty normal interest rate at the time, though it was very good. Whereas today, if you were to buy that exact same car with the exact term, but instead were to get an 8% interest rate, which is pretty normal nowadays, in fact, I would argue it's pretty good, you would be paying over $10,000 in interest payments throughout the life of that loan. That is a difference between a $591 car payment and a $741 car payment. So, of course, an extra $150 per month on your car payment that's going purely to interest is making it harder for people to be able to afford these loans. People have to make more money, they have to have a larger car budget, and as a result, more and more people are getting denied. But interest rates aren't the only thing that are affecting loan acceptance rates, because the credit crunch is as well. We haven't spoken about bank failures in a long time, but I'm sure many of us remember the infamous ones that happened earlier this year. And whenever Silicon Valley Bank and others failed in March of 2023, there was a lot of speculation that this could potentially cause a massive credit crunch, which is essentially whenever banks and lenders determine that they're going to be much more strict with who and how much money they loan out. This is oftentimes in an effort to hold cash to remain liquid, that way they can weather any storm. And the fact that banks like Silicon Valley Bank didn't do this is one of the reasons why Silicon Valley Bank failed. Around March of 2023, this was talked about constantly, and many people felt like it would have a massive impact on the economy. And while the credit crunch may have not sent shockwaves through the banking and financing industry, it absolutely did have an impact. And over the last few months, it's been significantly harder to get approved for auto loans, mortgages, and more. And while it isn't only because of the credit crunch certainly plays a role. But the interesting thing is that a credit crunch didn't actually get started in March of 2023 with these bank failures. It actually began much earlier than that, as early as 2022. It was reported back in January 2023 that the 6 largest banks in the United States were beginning to hoard cash in an effort to pay off bad debt. This is essentially what a credit crunch is, and this was done 2.5 months before Silicon Valley Bank failed. And in this article published by Bloomberg, they stated, and I quote, JP Morgan, Bank of America Corp., Citigroup Inc., and Wells Fargo & Company all put money aside in 2022 to cover potential pickup in bad debts. But perversely, this was as much about consumer confidence as it was about recession worries. Why? Because it was driven by growth in credit card borrowing among people out buying fun things. And in a separate publication this July, so just a couple of weeks ago, it was reported that these same banks have now put aside $7.6 billion worth of cash for these same types of bad debt. Now, like I mentioned a moment ago, part of big banks' concerns comes along with the amount of credit card debt that consumers hold. In fact, currently, the United States is at its highest level of credit card debt ever. And with that, I would like to go back to that Federal Reserve report that I mentioned earlier. There are varying reports, but as we sit here today, it looks as though the United States has about $1 trillion in credit card debt, which is a record high. Some reports state that we're in the mid-900 billions. Others have officially stated that we've hit $1 trillion. To be honest, it doesn't really matter for the sake of this video. What's important is to know that we are in a massive amount of consumer and credit card debt here in this country. And in the same Federal Reserve report that I mentioned earlier in the context of auto loans, it also had some data regarding credit cards as well. Over the course of the last 4 months, credit card applications have increased, so more people are applying for credit cards. And the amount of people that reported that they are more than likely to apply for one or more lines of credit in the next 12 months also rose. Debt delinquency expectations are also on the rise. This is the percentage of people who expect to not be able to make their minimum monthly debt payments over the course of the next 12 months. This is rising, though it is still lower than pre-pandemic numbers. And while these delinquency rates, whether we're talking about auto loan delinquency, consumer debt, or credit cards, they aren't expecting to exceed or at least significantly exceed pre-pandemic numbers, we have to keep in mind that the sheer volume of debt has increased. So while delinquency rate may not be higher than what we saw, say, in 2019, the sheer volume of debt will, and thus the amount of money that's going delinquent is going to increase substantially. Because today, people owe more on their credit cards, their cars, and their mortgages than they did pre-COVID. And so while default rates may just simply return to their pre-pandemic levels, default amounts won't. Because the volume of debt that we're talking about here has increased significantly over the last couple of years, and that's something that isn't talked about enough. And the thing is, not only people are at higher risk of defaulting, but companies and large industries are as well. According to a Bloomberg report, there are over $590 billion worth of corporate bonds and loans trading at distress levels, which could lead to the largest corporate debt storm that we've seen in decades, with some of the most vulnerable industries being those in real estate, healthcare, and telecom. And according to the same Bloomberg report, in the US, the amount of high-yield bonds and leveraged loans, which are owed by riskier, less creditworthy businesses, more than doubled from 2008 to $3 trillion in 2021. And that's a problem. Because not only have people, normal, everyday consumers, been taking on loads and loads of debt, but so have companies. And what happens whenever billions, if not trillions of dollars of debt stops being paid on and goes into default? Well, the dominoes begin to fall. The most recent Fed report, paired with the most recent interest rate hikes, paired with big banks' Q2 reports, paired with an ongoing credit crunch, all with the backdrop of a growing consumer debt problem, shows me that a storm is brewing. And I believe that it's going to lead to a massive wave of defaults. I've been saying this for an extremely long time, but I thoroughly believe that the debt situation here in the United States is unsustainable. And the thing is, this isn't just a consumer problem. This is a corporate America problem, a startup problem. It touches basically every single inch of the United States economy, and it's a major, major problem. Money was extremely cheap to borrow for a very long time, so companies and consumers borrowed trillions of it. But that same money is significantly harder and more expensive to come by now. The U.S. economy is slowing down, and this could lead to big trouble. The country's largest banks are holding on to cash, once large players in the automotive industry are leaving, and banks continue to tighten credit standards. I always say when smart people tell you something, you should listen. And the banks are telling us something, so we should really listen. Like always, if you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in my next video.